We have a big summer special. Jeffrey Christian, I think it's 46 minutes. How long is it? Hello and welcome to the Northern Miner Podcast. My name's Adrian Pocobelli, and I tell you, managing partner of CPM Group, Jeffrey Christian, advisor to central banks, governments, and those around the world of repute, drops some knowledge and drops some history as well as insights on the red-hot silver, platinum, and palladium markets, and copper as well. So a big, action-packed summer interview for you on this week's podcast. Welcome. We also have a great interview with Brian Lundeen, editor of Gold Newsletter and host of the New Orleans Investment Conference, two historical icons in the gold industry. So that is coming up on this week's Spotlight. Turning to the stories of the moment. Quite a lot going down as usual. China and the EU met. And of course, as we know from previous episodes and just following the news, one of the big sticking points, actually it was the primary sticking point, as we're reading in previous weeks here, for the EU were rare earths. Now, the New York Times on July 23rd, so last week, had a story on it. China and EU reached narrow agreements on climate and rare earths. And it's at the bottom that we actually see the reality on rare earths. It's quite interesting. Acrimony over rare earth metals. China forced the Trump administration to come to the bargaining table this spring, partly by halting most exports of rare earth metals, which are crucial for car makers, defense manufacturers, and many other industries. European nations initially hoped that they would be exempt from China's restrictions on rare earths, only to find that Beijing is using its control of most of the world's supply to demand concessions from them as well on issues like electric cars. China's Ministry of Commerce has allowed some shipments in recent weeks, but to the intense annoyance of European officials, it has approved only enough shipments to let European factories stay open, and not enough to let them build inventories to cushion against further interruptions. Ms. von der Leyen warned last month that in recent weeks, quote, "we all witnessed the cost and consequences of China's coercion through export restrictions," end quote. But Mr. Guo, the foreign ministry spokesman, defended China's export controls on Thursday, saying his country would work with, quote, "relevant countries and regions to jointly safeguard the stability and security of global production and supply chains," end quote. So what can we deduce from this article? To summarize, we could say China is exporting rare earths to the EU, but in reduced form, and they're not allowing them to stockpile. And I suspect, to bring out our speculative hat here, one could easily imagine the reason China doesn't want to allow any more than the commercially needed rare earths to be exported is so that Europe can't build its military. It just announced, in the last few months, it's going to spend $800 billion to $1 trillion on military expenditures. So they're going to need rare earths for that. And so it looks to me that they're saying, no, you can't stockpile. Because if you stockpile, we don't believe that you're not going to use that for military purposes. Now, interestingly, we're going to see a story with Indonesia coming up, where Indonesia is now citing the dual use regulations. Amazingly. So that is coming up in a few stories, but let's continue. We have another story. This is Euronews. So the first was the New York Times. Now we have Euronews. EU hails progress on China's rare earth curbs, but insists trade be rebalanced. And here's a quote from Ursula von der Leyen, the president of the European Commission, at the end of a one-day summit in Beijing. Quote, "These export controls have placed significant strain on some European companies. To keep trust in our trade relationship, we need reliable and secure supplies of critical raw materials from China," end quote. Von der Leyen welcomed China's effort to fast-track export licenses for rare earths and the establishment of a new system to address barriers and delay in the supply chain. Quote, "We agreed, and this is new, to have an upgraded export supply mechanism," end quote. In other words, if there are bottlenecks, this system can immediately check and solve the problem or the issues that is out there. So in other words, nothing has changed in terms of the policy, but we are willing to speed up the mechanism of the policy. Continuing, still, Von der Leyen insisted much more progress was needed to significantly rebalance EU-China trade relations, which last year saw a deficit in goods of over $300 billion. So that is where we are with EU and China, and it sounds like and I don't know if you saw it on X, there's some footage, I assume it's real, of, the European officials showing up in the equivalent of a Greyhound bus. And no pomp and ceremony, it is quite something, even for those that aren't necessarily super well versed in the protocols of diplomacy. Now, as I was mentioning, we have this other article from Reuters via mining.com, Indonesia discussing strategic management of critical minerals trade. Sounds innocuous enough. As it says here, the United States and Indonesia are discussing joint measures to monitor and manage trade in Indonesian critical minerals that have strategic value, an Indonesian minister said on Thursday, as he gave details of ongoing talks between the two countries. Indonesia is one of only a handful of countries to strike a deal with Washington to lower U.S. tariffs ahead of an August 1st deadline. The deal, referred to by the White House as an agreement on the negotiating framework, saw tariff rates on Indonesian products lowered to 19% from an earlier 32%. And here is the rub. But Chief Economic Minister Erlangga Hartarto told journalists that the two sides were still in discussion about how to better regulate trade in vital dual-use commodities. So here comes the dual-use commodities again, which is what China is using for the EU right now. They're saying basically, we'll give you rare earths for commercial applications, but we reserve the right to not deliver anything, regarding to the military under, non-proliferation protocols. Like, this is why the EU is so mad. They can't build their trillion-dollar military. So coming back to Indonesia, the Chief Economic Minister, Erlangga Hartarto, this is what she said in a briefing on the agreement recently struck with the United States. Quote, strategic trade management is important to ensure transparency between both parties so that imports and exports of dual-function commodities with strategic value can be monitored. End quote. And then the article continues, commodities considered strategic are those used in artificial intelligence infrastructure, data centers, aviation, and the aerospace and spaceflight industries, he said. Now, when you look at the aerospace and spaceflight and aviation, it seems like a very polite way of saying military applications, doesn't it? But that is an interpretation here. So the United States want to ensure that these strategic components do not fall into the hands of certain parties, including for use in terrorism or other purposes, end quote, Erlangga said. And that is what we're left with. Now, as it also says here, Indonesia is also the world's largest producer of nickel products, the biggest exporter of tin, and a major producer of copper. Chinese companies currently dominate the processing industry for nickel and bauxite in Indonesia. Erlangga also said that negotiations were on between the two countries to lower tariffs on Indonesian commodities entering the United States, adding that the rate would be close to 0%. The lower tariff could be applied on commodities that the United States cannot produce itself, the minister said. 0%. Like, what does that tell you? Like, to me, it tells me that Indonesia has quite a bit of leverage here. If they're getting tariffs of 0%, the minister also added that the two countries were discussing rules of origin and to what extent a, quote, third-party vendor, end quote, can be involved to be eligible for the lower tariff rates offered to Indonesian exports entering the U.S. market. So an article that could easily be lost in the shuffle, I would argue, is of quite interesting significance. We're getting the dual-use argument, and we're also seeing Indonesia somehow being able to negotiate a tariff rate of close to 0% on commodities that are being exported to the United States. Sounds like a better deal than Canada is getting. Sounds like a better deal than almost anybody is getting. So what is Indonesia giving? My question here on this article, and it's not clear to me, because, of course, Chinese investment has gone into the nickel processing in Indonesia, as well as the bauxite. So are Indonesia and the U.S. going to somehow collaborate on dual-use export controls? I mean, it sounds kind of unusual. One assumes in regard to China, but maybe it's in regard to Russia. But it's not like Russia needs any nickel or aluminum, for that matter. So Just raising a lot of question marks, that article. Continuing on. Now we have another story of the U.S. and the Defense Department investing in critical minerals. So a press release by the U.S. Department of Defense awards $6.2 million to sustain critical production of tungsten. July 22, 2025. The Department of Defense announced today a $6.2 million award to Gold Metal Resources via Title III of the Defense Production Act. Golden Metal Resources is the wholly owned operating subsidiary of publicly traded Guardian Metal Resources. The award will enable Golden Metal Resources to deliver a pre-feasibility study for a tungsten mining site, Pilot Mountain, located southeast of Hawthorne, Nevada. This investment, which utilizes funds from the additional Ukraine Supplemental Appropriations Act of 2022, supports the March 20th, 2025 Executive Order 14241 on immediate measures to increase American mineral production goals to facilitate domestic mineral production. And finally, we have a quote from Dr. Vic Ramdas, Acting Assistant Secretary of Defense for Industrial Base Policy. Quote, tungsten is an essential alloying metal for aerospace, ground vehicles, munitions, and many other defense systems. Developing a domestic source for tungsten is one of our top critical and strategic mineral priorities. End quote. So interesting development there. Now, the Defense Production Act is what was used for MP materials. And here's our next story. So this is the Financial Times op-ed. America mustn't surrender its best weapon in the critical minerals battle. This is by Laura Taylor Kale. Congress cannot afford to allow the Defense Production Act to expire. As it says here, the Pentagon's recent investment in MP materials, in which it committed to purchase 100% of the mining company's rare earth magnets for 10 years, is a creative game-changing potential use of America's Defense Production Act, or DPA. It offers the kind of clear demand signal that the private sector requires from the federal government. When overseeing Pentagon efforts to make supply chains independent of foreign adversaries, I learned that money and time are the real enemy, and mining and processing critical minerals eat up both. Investors don't like costly endeavors that take 20 to 30 years to reap the benefits, really spelling out the issue. As the cost of capital increases, the market will take time to adjust for the risk. Now, as it says here, scrolling down, it's set to expire in September, the DPA, unless Congress reauthorizes it immediately. Letting it expire would jeopardize the U.S.'s best chance to counter Chinese manipulation of critical minerals processing. Congress needs to reauthorize the DPA and fund it aggressively. So, as we were discussing in previous episodes, the concern of the markets and of keeping a free market really go out the window when we are discussing the crucial need for these materials for the military, don't they? I mean, national security at the end of the day will trump the free market, one imagines, is what we are seeing here, and it stands to reason. So it seems like that's what we're seeing here with the DPA. Now, finally, while the MP materials investment shocked the market, the reality is that the Pentagon has been using the DPA aggressively for the past 4 years. When I served in the Pentagon, the Defense Department made over $1 billion in grants under the Act for Strategic and Critical Materials, which is a lot of money, but when you consider the budget of the military and how crucial these metals are, one could make the argument for a higher amount. And it continues, but such grants aren't just a one-stop shop for free government dollars. The DPA can spur additional private investment. For example, when we awarded Graphite Creek a $37.5 million DPA grant for an Alaska graphite mine, it triggered a private investor-supported project to establish a downstream $435 million graphite processing plant in Ohio. With the right level of congressional funding, the Pentagon can enter into more long-term purchase agreements, as it did with MP Materials, helping innovative companies seeking to solve the critical minerals crisis. Rather than debating reauthorization, Congress should be aggressively increasing the monies available for the DPA and supply chain resilience. Without the Act, the U.S. would lose the most effective tool in our arsenal for ensuring economic security, spurring innovation, and addressing critical supply chain gaps. Congress needs to act now. And one more story from the FT, U.S. long overdue for a critical minerals stockpile, says mining boss. Ramaco Resources CEO defends an unusual deal the Pentagon struck with rival miner MP Materials. As it says, speaking to Energy Source, Randall Atkins, chief executive of Ramaco Resources, said a critical minerals stockpile was, quote, a long overdue matter that government needs to address, end quote, pointing out that China had, quote, rather effectively used rare earths as a critical negotiating point with us, end quote, in recent months. Scrolling down, Ramaco plans to produce commercial quantities of rare earths, including the so-called heavy rare earths that China has a particular stranglehold on, for Western customers by 2028. So now we're talking, let's call it 2.5, 3 years. The groundbreaking ceremony for the Brook Mine project this month, the first new rare earths mine in the U.S. in more than 70 years, came as the U.S. government penned a deal with Ramaco's rival miner, Las Vegas-based MP Materials. Randall Atkins, the CEO of Ramaco Resources, did not mind the deal at all. Interestingly, Atkins said the tie-up was, quote, a template, end quote, for the kind of support that the sector needed. New rare earths producers needed assurances that buyers would pay a price for their material that was not subject to, quote, the Chinese manipulation of the market, he said. Quote, MP was in danger given the tariff environment, said Atkins. I don't think the government wanted to see a U.S. flagship rare earths producer go down. They were a very logical party to construct a model of a business relationship with, and I do think the government will do it with others because it does make sense, end quote. Ramaco has drawn support from the Trump administration, including Energy Secretary Chris Wright, who has asked the company to accelerate its plans to develop its rare earth operations. Atkins said the group was working to speed up how quickly it would be able to start producing material and planned to be able to provide samples to potential customers by the middle of next year. The company is developing a rare earths mine and a facility to process the material. The construction of Ramaco's full-scale commercial facility, or big box plant, would begin next year and be operational by the end of 2027 or in 2028, said Atkins. The company hopes to be a supply of a substantial portion of the rare earths needed by the U.S. Ramaco did not have any government funding, but would be looking to put together a financing package for the roughly $500 million needed for the big box facility, which could include public and private sector investments, said Atkins. So that is Camilla Hodgson at the Financial Times. And another story here, White House taps mining expert to head National Security Office. This is Reuters via mining.com. The White House has tapped a former mining executive to head an office at the National Security Council focused on strengthening supply chains. Three sources said, as a pared down NSC zeroes in on a few of President Donald Trump's most oft-stated priorities. Scrolling down, the decision to tap a mining expert for a top NSC position offers a window into how national security priorities have shifted under U.S. President Donald Trump. And scrolling down a little further, one of the sources said Copley's remit is, broadly speaking, quote, geostrategic affairs, end quote. Geostrategy is a field of international relations that focuses in part on the interplay of resource wealth and security, a matter of particular relevance for an administration that has made securing access to foreign resources a central element of its foreign policy. We didn't really need any more evidence of the priority of critical minerals for the United States, but nevertheless, an interesting story. And finally, just a couple of more on the critical minerals. U.S. targets mine waste to boost local critical minerals supply. This is Cecilia Jamasmy at mining.com. The U.S. government has launched a new effort to extract valuable critical minerals, including rare earths, lithium, cobalt, and uranium, from mine waste and abandoned sites, aiming to reduce dependence on foreign suppliers and strengthen domestic production. Interior Secretary Doug Burgum has ordered a series of regulatory changes to streamline federal oversight and fast-track projects recovering minerals from coal refuse, tailings, and shuttered uranium mines. So, Jeffrey Christian brings this up in our interview about the increased importance of recycling in regard to supplying these metals in the future. And then we've gotten a couple of interesting reports. I don't know how reliable these are, just to preface this, but I did see a report on YouTube and also in this website called the East African. Felix Tshisekedi, the president of the DRC, Tshisekedi security chiefs detained in assassination plot probe. As it says here, this is Patrick Ilunga at the East African. Authorities in the Democratic Republic of Congo are cracking down on senior military officials over a suspected plot against President Felix Tshisekedi. Several senior soldiers in the Congolese army, FARDC, including head of the president's security, Frank Natumba, and presidential advisor Christian Chiwewe, have been arrested on allegations of a conspiracy to assassinate the head of state. So that is a report. Finally, Barrick in Mali. Mali judge rejects Barrick appeal to free detained employees. This is Cecilia Chamasmi at mining.com, and you have to feel for these employees who have been arrested in November. A court in Mali has rejected Barrick Mining's appeal to release 4 employees arrested in November, deepening a high-stakes standoff between the Canadian mining giant and the country's military-led government. Judge Sambasar ruled the appeal unfounded, according to Barrick, which has repeatedly dismissed the charges as politically motivated and legally baseless. The employees, local staff working at Barrick's Loulo-Gounkoto gold mine, remain in pretrial detention in Bamako. They face allegations including money laundering and regulatory violations, Alifa Habib Cohn, a lawyer for Barrick, told Reuters on Tuesday. Bristow and the company have rejected all allegations, calling them without merit. So we are officially in the dog days of summer here, July 23rd to August 23rd. If you are wondering, according to Google here, but nothing is slowing down really in terms of the resource nationalism, really the meta headline here behind all the headlines today, resource nationalism alive and well. So if you want to find us online, you can find us at northernminer.com. You can find us on X at northernminer. Find us on Instagram at The Northern Miner and on Facebook, LinkedIn, and YouTube, where we also host these podcasts and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcasts. And with that, let's turn to Brian Lundeen, editor of Gold Newsletter and host of the New Orleans Investment Conference, for this week's Spotlight. Join us today. I'm very pleased to welcome to the Northern Miner podcast for this week's Spotlight, Brian Lundeen, editor of Gold Newsletter and host of the New Orleans Investment Conference. Brian, welcome to the show.
Great to be with you. Thank you so much.
It's great to have you. I imagine it is exciting times running a gold newsletter these days. What is it like right now? I imagine it's exciting.
Yeah, it really is. You know, Adrian, Gold Newsletter is actually the oldest publication in the precious metals universe. And frankly, I believe it is the oldest investment newsletter, the longest running investment newsletter in the world today. We're in our 55th year. So we've been around for a few cycles and seen a few things in gold and precious metals and mining stocks. And this really is, I believe, the best opportunity we've ever seen. We've never had a bull market in gold and mining stocks where gold has moved so far, so fast, without the participation of Western investors and the mining sector. So right now, the mining sector, from the majors on down to the juniors, although they've all made some pretty significant moves, they are at fundamentally undervalued levels relative to the gold price. And now silver is starting to move as well. So I think, and I have been telling my readers and anyone who would listen, frankly, that this is a generational opportunity. I think this has elements of the 1970s. It has elements of the early 2000s. But the hard part's done. The metals prices are already in the stratosphere, at least for gold. And now the miners are being pulled up behind it. And they are extraordinary values, extraordinary opportunities right now.
That is super interesting. So despite a move, in terms of valuations, maybe like PE ratio, with the gold price doing what it's done, in a sense, in your opinion, perhaps it's an even better opportunity than it was 2 years ago or a year and a half ago before this big move.
Yeah, well, certainly less risk. You know, a year and a half ago, everything was selling for a good bit less. The big miners were 50, 60% less than they are today. But the risk is no longer there. We've had the big move in gold. Everyone was waiting for gold to break out. It broke out for reasons that were unexpected, kind of out of left field. The central banks of the world just flocking into the metal and not just making a one-time move, but making gold purchases part of programs to reestablish gold as a very important part of their reserves. You know, gold has recently exceeded the euro as the second largest component of central bank reserves. The only one left to overtake is the dollar. The trajectory is there. The dollar is falling as a component. It's a percentage of foreign reserves, and gold is rising. So it'll be a while before they cross, but the trend is clear. And again, the mining stocks are still at fundamentally undervalued really at long-term low levels and represent just an extraordinary opportunity.
Okay, very interesting. And is this across the board, or would you say this is more, oriented towards the large caps and the mid caps, developers? What is your sense on that? Or is it, more of a universal type move across the gold miners?
It's universal, but it is in that respect playing out as it typically does, in that the big miners start first and you go down to the mid caps. And really, when you start to get the generalist investors involved, they start going down the food chain to get more leverage, more torque to the move. And then they start discovering these really high potential junior mining stocks. And that's where we're going right now, even though as we speak, in the middle of the summer, gold's in a bit of its typical summertime doldrums. The junior mining market is still fairly active. We've got a lot of news being made. The companies are raising money right and left and being able to negotiate their terms. So that's different than what we've seen for a very long time in that sector. And so, yeah, it's across the board, but only now really migrating into the junior mining sector.
And you mentioned silver as well. I mean, it's kind of well known, the silver stocks is perhaps, I don't know if we'd say it not being the most liquid market, but, there aren't a whole bunch of companies to choose from. I mean, what do you think of that? Like, what is your sense of the silver stock market?
It's great. I think it's on the launching pad right now. Silver offers natural leverage to gold, and the silver juniors and silver mining stocks in general offer leverage to silver. So you can stack leverage on top of leverage by getting involved in silver miners and silver junior miners. So I think they are on the launching pad right now. Silver starting to move. It has its eyes set, I believe, on $40 in the near term. And that's going to spark even more attention into that relatively small sector of junior miners. So a lot of money will be going into a sector that's even far smaller than the junior gold miners. And the results will be explosive, I believe.
Okay, excellent and very exciting. And I want to get to the conference, to the New Orleans Investment Conference in a second, but could you just tell us a little bit about the newsletter? How do you structure it out? Like, do you have picks? Is there commentary? Like, tell us a little bit about Gold Newsletter.
Yeah, it started off as is really the primary tool in a guy named Jim Blanchard's efforts to get gold legalized in the early 1970s. Over the years, we've evolved it into coverage of the sectors, and these days I write it and I cover macroeconomics, I cover the metals markets, and we cover some 24 or so junior mining stocks. I've been in this market for decades and know just about everybody in the sector. So I have my network of spies, as it were, out there trying to find the best deals, the earliest good deals by great management teams early on in their lifespan. And that's what we bring to our subscribers. And it's been very, very successful very recently and really over decades.
That is impressive that it's been around that long in the newsletter business. I love the newsletter business, by the way. And so as we wrap up here, Brian, tell us about the New Orleans Investment Conference. In a sense, what are you up to there and why should people attend?
Yeah, the New Orleans Conference is the longest running investment event in the world. We just celebrated our 50th anniversary. It's all part and parcel of what Jim Blanchard started in the early 70s, and I went to work for him in the 80s. And now, after he passed away in the late 1990s, I bought the remaining interest in the business and have been running it since around 2000. So the conference over the years has evolved. It was originally a gold conference to teach investors how to invest in gold. Over the years, we've evolved to cover every sector, which we still do today. But one common theme has remained consistent, and that's that when the metals and the miners are in a bull market, the New Orleans Investment Conference is the place to be. We gather many of the top experts in the world and really in recent world history. We featured Ayn Rand in her last public presentation. We've had Margaret Thatcher, Milton Friedman many times, Alan Greenspan many times. The list goes on and on and on. And these days, we feature a lot of the big thought leaders out there that you'll see on X and social media. And they come to the New Orleans conference. You get to meet them, get to hear from them, get to ask them your questions. It is I believe, and I think most people agree, the elite investment event especially for those interested in metals and miners.
I mean, that is pretty impressive. That is a whole bunch of historical names there. Ayn Rand at the conference. That is impressive. So as we wrap up here, Brian, when is the conference? And if people want to attend, what should they do? And if they're interested in your newsletter, in Gold Newsletter, where should they go?
Yeah, the New Orleans conference this year is November 2nd to 5th in New Orleans, of all places. You can find out information, get a look at our early roster. We're still building it at this point, but get an idea of the kinds of speakers we bring together at neworleansconference.com. In Gold Newsletter, I believe it's the best value in metals and mining newsletters, and you can find out about it at goldnewsletter.com.
Brian Lundeen, editor of Gold Newsletter and host of the New Orleans Investment Conference. Thank you for joining us on this week's Spotlight.
Thank you, Adrian.
And thank you once again to Gold Newsletter and the New Orleans Investment Conference for sponsoring this week's episode of the Northern Miner Podcast. Turning to the website, China's lithium markets gripped by possible supply disruptions. And we have seen again a big jump in lithium. It is now $10.30 per kilogram. Let's take a closer look. This is Bloomberg News via mining.com. Chinese markets for lithium, a key battery metal, are seeing heightened volatility after investors bid up prices to guard against possible supply disruptions. Lithium carbonate traded on the Guangzhou Futures Exchange rose by its daily limit of 8% on Friday, capping a 14% gain for the week. That prompted the bourse to issue a notice reining in speculative trades, which helped push futures limit down on Monday. Shares of producers also jumped, with Tianqi Lithium and Changxin Lithium Group both rallying around 25% this month in Shenzhen. The gains came after moves that could ultimately lead to less supply amid growing anxiety over the production outlook, as well as the government's focus on curbing industries with too much capacity as part of its campaign against so-called involution. Quote, speculative trading on the back of market noise has led to a sharp rise in prices, end quote, said Robin Tisserand, head of battery metals at brokerage SCB Group. So that was July 28th. Then we have this story from a staff writer at mining.com. China's lithium capital flags permit issues at 8 mines. Authorities in China's Jiangxi province have identified permitting issues at 8 lithium mines in Yichun, one of the country's key production hubs, as Beijing tightens oversight of its critical minerals sector. The Yichun Natural Resources Bureau recently issued notices to the mine operators requiring them to provide resource reserve verification reports after finding discrepancies between their licensed mining rights and the actual minerals being extracted, according to a report by Benchmark Mineral Intelligence. It follows similar measures taken last week in the western province of Qinghai, where local authorities in Hechi Prefecture ordered the shutdown of a mine run by Zhangye Mining until proper lithium extraction permits are obtained. According to ministry findings, many of the resource extraction activities across the province's salt lakes are not licensed for lithium, but other minerals such as potash. So interesting crackdown in China. I mean, I do wonder to myself, with the crackdown on rare earths and this hyper-tracking, we might say, of the rare earths industry in China, I wonder to myself, are they getting ahead of this issue with lithium? Are they, in a sense, starting to slow down the export of lithium to a certain degree in order to better control it and kind of monitor it? I mean, pure speculation over here, but it's kind of an odd story. I mean, what is the cause behind this? What is the directive here? Let's continue. Platinum price rally pulls producers from the brink, Valterra CEO says. This is Reuters via mining.com. The platinum price rally during the first half of 2025 has helped most mines recover from loss-making positions, but the industry is still far from adding new production, Valterra Platinum CEO Craig Miller said on Monday. South African miners, which account for over 70% of the world's platinum supply, cut out unprofitable production over the past 2 years after metal prices collapsed, amid warnings that the industry was in terminal decline. Quote, about 90% of the industry is now making money, or just breaking even, versus 40% at the end of last year, end quote, Miller told Reuters in an interview. However, prices are still not high enough for the industry to consider adding new production. He added, quote, "You need to see another 50% increase in prices in order to incentivize that new production to come to market. So we still think there's some way to go," end quote, Miller said. Fascinating article there. Continuing on. Ghana cancels $1.2 billion bauxite deal eyes global partnership. This is Reuters via mining.com. Ghana has canceled a $1.2 billion bauxite lease with local firm Rockshire International, seeking a partnership instead with a big overseas company to tap one of West Africa's richest deposits, three sources with direct knowledge of the matter said. Potential partners include Dubai-based Emirates Global Aluminum, or EGA, or a Chinese firm, two of the sources said. The termination marks a strategic pivot by Ghana, which holds an estimated 900 million metric tons of bauxite, the seventh largest globally, but has struggled to attract sustained investment in mining and refining infrastructure. Rockshire's lease covered the Nianahin Hills in central Ghana, home to about 376 million tons of bauxite, the feedstock for aluminum. Continuing on, Congo is targeting cobalt price that boosts local processing. It's Bloomberg News via mining.com. The Democratic Republic of Congo is seeking a cobalt price that encourages domestic processing as the government considers its next steps to follow a ban on exports of the battery metal, according to the chairman of the state mining company. Congo, which accounts for about 3/4 of global cobalt supply, suspended shipments for 4 months on February 22nd before extending the ban by 3 months in June. The decision came after prices slumped in recent years as output soared, particularly from two mines operated by China's CMOC Group. And don't forget, there's a story about a year ago, maybe even a year and a half ago, where China said they were starting to stockpile cobalt. So, perhaps a bit of a conflict of interest there. Quote, "No one can invest in a refinery in the country because the price was not sustainable," end quote, Jeka Mines chairman Guy Robert Lukama said in a discussion this week with Washington-based Center for Strategic and International Studies. Congo's mines export an intermediate product called cobalt hydroxide, which is transformed into battery-grade material or metal elsewhere, mainly in China. So Congo wanting more processing in-country, which sounds reasonable. Sierra resumes graphite shipments from Mozambique mine. This is Bloomberg News via mining.com. Australian graphite miner Sierra Resources is resuming shipments from Mozambique after halting deliveries due to post-election violence in the Southeast African nation. And many of you will remember this story. This is from December. The company, supported by the U.S. International Development Finance Corporation, said it restarted production at its Balama graphite mine last month and is now preparing shipments, according to a Wednesday statement. One cargo of the battery material is being loaded at Pemba Port, and another is planned before the end of September, the firm said. Sierra stopped operations in December using a rule called force majeure that lets companies suspend deliveries because of events they can't control, in this case deadly civil unrest that rocked Mozambique following disputed elections. The U.S. government has loaned the firm nearly $250 million in funding through the DFC and Department of Energy to help build stronger supply chains. Very interesting. And continuing on, tech setbacks in Chile underscore copper supply struggles. This is Bloomberg News via mining.com. Teck Resources lowered production guidance for its flagship Chilean mine in the latest setback to the Canadian company's efforts to join the copper big leagues. The sprawling Quebrada Blanca open-pit operation in the high Andes is grappling with tailing storage issues, which is requiring additional spending and restricting production, Teck said in an earnings statement and call Thursday. The sprawling Quebrada Blanca open-pit operation in the high Andes is grappling with tailing storage issues, which is requiring additional spending and restricting production, Teck said in an earnings statement and call Thursday. The tailing hitches follow plant and geotechnical setbacks that have disrupted Quebrada Blanca's ramp-up after a major overhaul that came in $4 billion over budget and years behind schedule. The struggles at an operation dubbed QB2 show how the mining industry is battling to expand supply when the world faces a looming shortage of the key metal. But you can't mess around with tailings ponds. Quote, "The market is unlikely to give Teck credit for this ramp-up of production until it is actually achieved, as there is some question as to whether there are structural issues with the asset," end quote, the analysts wrote in a Thursday note to clients. Continuing on the copper beat, Japan copper smelters face tough talks with global miners over processing fee. This is Reuters via mining.com. Japanese copper smelters face tough mid-year negotiations with global miners over treatment and processing charges, as they wouldn't be able to accept the very low terms that Chinese smelters agreed with suppliers, the Japanese Mining Industry Association's head said on Thursday. Some Chinese smelters agreed to $0 per metric ton and 0 cents per pound with Chilean miner Antofagasta during mid-year talks last month. These rates are seen as an industry benchmark and compare with the 2025 annual charges at $21.25 a ton and $2.12 per pound agreed between the Chilean company and Chinese smelters. So, Chinese smelters are offering free treatment and processing. Japanese smelters, by contrast, had secured charges of $25 a ton and 2.5 cents per pound for 2025 by around May, according to two industry sources. They are now engaged in mid-year talks to maintain higher margins than their Chinese counterparts, JMIA Chairman Tetsuya Tanaka said. Quote, still, negotiations are proving very difficult as the miners have proposed charges even lower than the 2025 annual levels, end quote, Tanaka told a news conference. Tanaka warned shrinking smelting margins are placing non-Chinese smelters under severe pressure. Very interesting story there, and just a headline, Peru mulls green light for $6 billion in mining projects. This is Reuters, and you can read the whole thing on mining.com. Continuing on, Serbia will hoard all its gold at home, shunning global hubs. This is Bloomberg News via mining.com. Serbia's central bank plans to bring all of its roughly $6 billion worth of gold reserves onto its own soil to ensure the security of the hoard in periods of crisis. This will make Serbia the first Eastern European country not to hold any of its bullion in traditional hubs like Switzerland, the UK, and the United States. Quote, by returning gold to the country, the National Bank of Serbia sought to increase the availability and security of gold reserves in periods of crisis and uncertainty, end quote, the central bank said in response to questions, adding that the repatriation efforts began in 2021 amid, quote, an environment of increased global uncertainty, end quote. Very interesting there. Continuing on, Zijin leads race to buy Barrick's Ivory Coast gold mine. This is Reuters via mining.com. So, China's Zijin Mining is the frontrunner to acquire Barrick Mining's Tongon gold mine in northern Ivory Coast for up to $500 million, two sources close to the matter told Reuters. Barrick, the world's third largest gold producer, is pivoting towards high-margin, long-life assets with a growing focus on copper and strategic operations in Africa and the Middle East. Scrolling down, the two sources said Barrick had appointed Canada-based TD Securities and Australia-based Treadstone Resource Partners to advise on the sale of the Tongon mine, which according to Barrick produced 148,000 ounces of gold in 2024 worth $504 million at current prices. Barrick expects the mine to enter care and maintenance by 2027 due to declining resources. Continuing on, Newmont cost-cutting helps boost earnings as gold prices rally. It's Bloomberg News via mining.com. Newmont has made progress getting its costs under control, helping the world's top gold miner beat expectations on earnings at a time when a rally for the precious metal is underpinning the industry. The producer's all-in sustaining costs, the industry benchmark gauge for expenses, decreased about 4% to $1,593 per bullion ounce in the second quarter, the company said Thursday. That came in under analysts' expectations. And just a few headlines, Germany gives Vulcan Energy 104 million euros to produce clean lithium. That is Reuters via mining.com. Another headline, battery startup raises $200 million to fund Northvolt deal. You do get the sense the lithium market has bottomed, as we're going to see again in metal prices. Those are your news stories. Now, let's take a look at metal prices. And turning to metal prices, let's take a quick look at the bond market. For context, the U.S. 10-year bond is yielding 4.4%. That is 0.02% higher than last week. The UK 10-year gilt is yielding 4.64%. That is 0.04% higher than last week. The Italy 10-year bond is yielding 3.52%. That is 0.03% higher than last week. The German 10-year bond is yielding 2.69%. That is 0.07% higher than last week. And the Japanese 10-year bond is yielding 1.56%. That is 0.06% higher than last week. So bond yields edging higher across the board. Turning to precious metals, Gold is trading at $3,323.30 per ounce. That is $76 lower than last week. Silver is trading at $38.33 per ounce. That is 80 cents lower than last week. So still hot, but cooling its jets a little bit. Platinum is trading at $1,405.60 per ounce. That is $67 lower than last week. And palladium is trading at $1,294 even. That is $14 lower than last week. Turning to industrial metals, copper is trading at $5.59 per pound. That is 2 cents lower than last week. Iron ore is trading at $98.55 per metric ton. That is $1.33 higher than last week. Aluminum is unchanged at $1.20 per pound. Lead is a penny higher at 92 cents per pound. Nickel is back below $7 at $6.92 per pound. That is 11 cents lower than last week. Tin is trading at $15.45 per pound. That is 28 cents higher than last week. Cobalt is unchanged at $15.12 per pound. Lithium is back above $10 at $10.30 per kilogram. That is 82 cents higher than last week. Uranium is trading at $71.65 per pound. That is 65 cents higher than last week. And zinc is slightly lower at $1.28 per pound. That is a penny lower than last week. Zooming out, metals as a whole consolidate recent gains, while lithium is the big standout, back above $10 per kilogram. And those are your metal prices. Coming up, I'm very pleased to welcome back to the program Jeffrey Christian, managing partner at CPM Group. We have a fascinating discussion on macro, as well as the importance of liquidity in the gold market versus currencies. We also discuss silver, platinum, and palladium, red hot markets right now. It's a wonderful, extended discussion. I hope you enjoy it, and I will see you on the other side.
Joining us today, I'm very pleased to welcome back to the Northern Miner Podcast, Jeffrey Christian, managing partner at CPM Group. Jeff, welcome back. You must be busy.
I am very busy. I may be busier than any time in my career, which has now spanned 50 years. Yeah.
That is quite something to say. Now, if I was to hazard a guess, it is several metals conspiring at the same time, where you had the big gold run, and there's probably still a lot of interest in gold. But then we had recently the gigantic moves, really, in palladium, platinum, and silver. They look like close to 50% we're looking at here, maybe 45. Is that the reason you are so busy?
That's part of the reason. But, I think if you think of it, there are layers of cause. Gold, silver, platinum, palladium. But we're getting an enormous amount of demand for information about industrial metals, everything from lithium and manganese to niobium and tantalum, which are used in semiconductors, and base metals. And obviously the copper market has gone crazy with the tariffs that the U.S. has imposed. So I think that, it's gold, it's silver, it's platinum. People say, okay, you're very busy. What are you busy with? What areas of your business are most compelling right now? And the answer is it's really across the board. And I think that speaks to the root cause, which is the worsening economic and political system environment worldwide. And that's what's causing the gold, silver, platinum, palladium, copper, lithium, and everything else to be so A, wild, B, price volatile, and C, uncertain. And that uncertainty drives people to hire companies like CPM Group to try to help them understand, why is it that platinum prices, having moved within a $200, $300 band for 10 years, rises 50% in 6-7 weeks?
It is remarkable. I mean, you have commented in the past on the low liquidity, in a sense, in some of these markets, but I want to come back to the point you're making that this is like the way you're characterizing this interestingly, is like a safety trade, but one that includes the base metals. Like that sounds like another order of
Yeah.
magnitude of safety. This isn't safety of gold and silver, but then we're worried about Dr. Copper going down and the economy going down, right? And that maybe copper goes down. This sounds like let's retreat to real assets, which is kind of a higher order of safety trade, I would argue. What do you think?
That's one way of looking at it. It's a very interesting way of looking at it. One of the things to pay attention to is the fact that there is this enormous amount of money sloshing around the world, and a lot of it, an enormous, historically large percentage perhaps, is in cash, looking for places to invest. And some of those places that they want to invest are the safety trades, gold and silver. But there is this bigger issue, which is given what may be fundamental shifts in the way the world operates, the mechanics of international trade, of industry. There are a lot of people who want to be investing in the raw materials of life, and you don't. I mean, how do you invest in lithium or rare earths? You invest in the mining companies. Well, how do you choose mining companies? And when you get into rare earths, it's a tough call to separate the wheat from the chaff. So I think that it's a combination of things, but part of the issue is you've got this enormous amount of money. You have more money that is being held offshore in US treasuries than ever before. And it's been rising like 10, 11% per annum. So investors are looking at the world. Part of the problem is the US deficit and debt. But because the US dollar is one of those risk assets that you turn to, like gold and silver, people are saying, okay, the US government is really working hard to damage the world economically and politically. I've got to find a safe harbor. What's the safe harbor? US treasuries. So you have this very ironic thing, which is the very institution that is one of the major factors driving the uncertainty and anxieties and heightened risk is the biggest beneficiary of those uncertainties and anxieties. And then you have people sitting there in cash saying, well, what am I going to do with it? So, yeah, I should have more gold and silver, that's for sure. Oh, platinum and palladium are starting to rise for the first time. For platinum, it was the first time since 2014. So it's actually 11 years, not 10. Palladium, came down with a thud from $2,200 in 2022 to $800, $900 over the last couple of years. Now it's back up to $1,300. Okay, so those might be good investments, partly because the mining industry that produce those two metals are suffering. And then you just go along the line. So one of the questions we get from institutional investors, high net worth individuals, family offices is, where do I put my money? Because I have more money sitting in cash looking for good investments now than ever before, but there seems to be a paucity of good investments.
Well, it speaks to this whole notion that this is somewhat of a value play. Like in a market where the multiples in the stock market are pretty high, all of a sudden, nickel at $7 or lithium at, I think it was $9 last week, kind of looked like it bottomed a bit. Kind of seems like it's a value play. But I also wonder, and I'd be curious your take on this, is this also kind of a bit of a retreat from the US dollar somewhat? Technically, it seems to be having some issues. Is this a dollar issue?
The dollar's in there. And again, it goes back to what I was saying about the treasuries. The treasuries and the dollar kind of overlap a little bit. Right now, the treasuries and the dollar are still the de facto reserve currency. People would like to have alternatives. You look at the European economy and some of the other economies that have liquid currencies, and they don't necessarily present a compelling argument to move into those currencies. But you also have, it's not just an anti-dollar thing, it's an anti-investing in the US thing. Yeah, the dollar's off 10, 12% on a trade weighted basis so far this year, in the first half of this year. And it's off probably a little bit more in terms of its exchange rate with the euro. But it's still very high by historic standards. And it's high because people want to buy treasuries. They want to buy investments in the United States, either real estate or companies or equities or whatever. And they need dollars to do that. But at the same time, they're trying to diversify their portfolio away from the dollar. And in order to do that, you need to buy euros to invest in European things. You need to buy other currencies. So there's a push and a pull in the currency market. And I think the key to understanding the dollar's position right now is to understand that still the US economy, I think, is about 26% of world GDP. It has a tremendous number of comparative advantages relative to European economies and other economies. It has a tremendous number of problems, and those problems seem to be getting worse. But by the same token, it still has that place. So, the dollar is important, but, where else do I go? And when you look, okay, the euro has greater liquidity than any other currency, but the euro liquidity is probably, let's say, a quarter of what the dollar liquidity is. And then when you start getting into other investment locations, the Middle East, Middle Eastern currencies, or Swiss or the UK or South Korea or Japan, or Southeast Asian countries, to get into those currencies to make investments in those areas is extremely difficult because they are so far less liquid than the US dollar. So it's a complex thing. But, again, it's like, you say, well, am I busy because of people going into gold, silver, platinum, palladium, and other commodities? Yes, but the root cause is what's driving them into those commodities. And the same thing is with the US dollar. It's like, yeah, the US dollar is in this push and pull. On the one hand, people are buying dollars because they want to invest in the US because it's got advantages. But on the other hand, they want to get rid of dollars because they want to go into these other currencies. But these other currencies are so illiquid. It's very difficult to invest in, say, a West African company.
Very interesting. And just on that point, like, say, if we were to compare, say, South Korea's currency, what is the South Korean
The
currency?
won.
The won. If we were to compare that to the gold market, do you have any sense of which is more liquid?
The gold market is much more liquid than the South Korean won. At least it used to be. I haven't looked at it
Interesting.
recently. Yeah.
But that is fascinating. So in a sense, when you start looking at things in terms of liquidity, that's
Right.
also an argument for gold to a certain degree.
Absolutely. Yeah. I mean, if you're an investor and you think, well, I may be moving to Berlin soon, just to get out of the United States. If you're an investor anywhere in the world and you think on an international basis and you say, okay, let's say that I want to move from where I am today to another country. What do I want to have as my core asset, my savings? And the dollar and gold are the two most liquid things to look at, really. So that's a key thing. And this is something that's gone on for centuries. I mean, if you go back to the United States in the 1800s and 19th century, with the Western expansion, the major currency that was used in transactions were silver pieces of 8, Spanish and Mexican silver coins. Yeah. And if you look at other countries, you'll see the same sort of thing. So one of the things is if you want to have financial mobility, gold is an excellent vehicle to have for that purpose. Because if you show up in Indonesia and you say, I have all my wealth in South Korean won or Swiss franc, you're probably going to have a higher exchange friction. The cost of exchanging from that to a different currency will be higher than it would probably be for gold.
Yeah, that is totally fascinating. I mean, in a sense, the practicalities of
Exactly.
of
Right.
actually moving money around, the real world business, moving money around in large scale, right?
Mhm.
Okay, so zooming out then, looking at the metals, I mean, we've seen a 50% move. People say 20% is a new bull market. What do you think? Like, are we at this long fabled beginning or even further into a bull market into the metals as a whole?
Yeah, I think that things, yeah, again, go back to, the root cause, which is economic and political uncertainties at a time of massive liquidity, right? And where do you want to put that money? And you mentioned like the high valuations in the stock markets, and I haven't really looked at it recently, but I think about 6 months ago, when you looked at the high valuations in the stock market, let's look at the NASDAQ index or let's look at the S&P, and you say, okay, how many winners, how many losers? What are the companies? You had, 10 companies that were the big winners and 490 companies that weren't doing so well, or were reasonable returns, 5%, 10% returns, or 5%, 10% losses. You had this big mass of equity, but there were a few winners. And then you start looking at those winners, the big winners that are driving the equity indices to record prices. And a lot of them are shells, to be honest. I mean, you have companies that were not even in existence 10 years ago. They're making something that no one understands. They're making something that doesn't actually work, but everybody's buying. They can disappear tomorrow. I was thinking about it over the weekend, and I was thinking about the extent to which the current drive with AI and technology really is a lot like the tech bubble of 1997 to 2000, 2001. Yeah, where you had this massive amount of money going into new technologies and companies that really didn't have anything to sell, didn't have any revenue. Yeah. Until 2 years ago, you couldn't calculate the PE ratio for Tesla because it never had earnings. Right? It was always at a loss. So, you couldn't say, well, it's got a 5,000 PE ratio because it had no earnings. There's a lot of similarities to where we are today in the equity market to where we were in 1999, 2000 in the internet stock boom. High valuations on stock indices, but if you disaggregated them, more losers than winners, and a couple really big winners that were extremely vulnerable because they had structural problems. And some of them were technology companies, but let's be honest, there were companies like Enron, which turned out to be pretty much a shell game. And people were willing to buy into it because the price was rising. And then all of a sudden, they were the biggest losers.
In a sense, I dare restate my question. Do you think we're in a new bull market, or is it
For
kind of
things.
for things? Yeah, for
Yeah,
real world
real
assets.
things. Look, lithium may be overvalued right now. I mean, it may be cheap on a short-term basis. On a longer-term basis, it may be overvalued because you're seeing a slowing down in electric vehicle building. And the fact is that you really don't need to build new lithium mines. You're starting to see lithium recycled from end-of-life batteries, and that'll increase the supply of lithium and reduce the need for new mines. You have a number of things that you have to look at. But the bottom line is that you're sort of where you were in the 1870s. Like, if I'm investing in something that I want to have a real return that's sustainable, that's not vulnerable to a sharp decline, like Enron, if that was a decline, a collapse, I want to own something that either is a thing or makes a thing, right? So a copper mine makes sense. Owning copper, well, it makes sense, except that it's extremely cumbersome to own copper, physical copper. You can own copper ETFs and you can own copper futures and forwards, LME forwards, but it's difficult to invest directly in the things. So then you wind up looking for companies that make those things. And that's really a key.
I want to go to some of the individual metals that are exciting you, but just on the point of, say, the copper ETFs, like in a sense, as a layperson investor without any of the specialty expertise that you guys would have over there at CPM Group, you look at the copper ETF and you say, great, I'm investing in copper. What's the problem? Right. So
Right.
what's wrong with that thinking?
I don't know that there's anything wrong with that. And frankly, ETFs may be the best way to invest in some of the metals. I mean, gold and silver, platinum and palladium to a lesser extent, are financial assets in that they have a very high value to volume or value to weight ratio. When you start getting into copper, or some of the metals. I mean, 15 years ago there was a ex-Watergate guy touting beryllium on the late night TV, and beryllium's toxic. You don't want to own beryllium and store it in your garage. So there are problems with owning those things, and the ETFs may be the best way to buy that exposure.
Okay, very interesting. So let's maybe start then with copper.
Okay,
We've had a pretty big run. I think we could call these record prices, could we not? We're,
probably, yeah.
we're almost at $6 a pound here.
Well, it came
Illy,
off today. It's about 578 right
yeah,
now.
like I mean, we're approaching
Yeah.
that $6
Well, it got
handle.
up to 585 this morning. Last week it was 590 something. So yeah, it's virtually
Right. Okay.
$6. Yeah.
Amazing, right? So,
Hmm.
I mean, for those of us that have been following the copper story for, near a decade of these, concerns from credible people like Mark Bristow saying, there's not going to be enough copper, Robert Friedland, and with all
Right.
of this investment into militaries that we're seeing massive budgets. Like, I think the sense is from people who've been watching this that this move is just getting started. You think of Jeff Curry, who said that copper could pull an oil, where it went from $10 to $100 a barrel. What is your sense of where we are with copper and what might happen?
Well, I think when you talk about the potential for copper prices or potential for price increases in any asset, you have to understand that there are two conversations. So, yeah, oil went from $10 to $100. Yeah, on an intraday basis, but on an annual average basis, it went from $10 to $90, or $80 or $70. So when I look at copper, we tend to be longer term investment oriented people. So we'll look at copper and say, yeah, the price is probably going to rise and rise significantly on a sustained basis over the next 10 years. However, there's this cyclicality and there's this volatility. And the volatility partly comes from the ebb and flow of investor funds into the market. So copper has the capacity to rise very sharply. People, I studied copper in the 70s, and I've continued to follow it, and my partner Carlos Sanchez follows it still, but I'm a little bit less versed with it. People will ask me, well, can silver get to $50 and can silver get to $75? And I'll say on an intraday basis, yeah, but it can't stay there because of the fundamentals. So we look at copper and we say, okay, on a fundamental basis, the market is tight. It's probably going to get tighter. The hype about electrification and the ongoing need for copper is probably somewhat overdone, but it's based on a reality. Yes, we need more copper. There's plenty of copper out there either to be mined or, very importantly, to be recycled from old end of life products. If you take a train from Berlin to Bonn, if you take a train from New York to Washington, you go through the backyards of America and you see just junkyard after junkyard full of cars and trucks and other things that have steel and copper and other aluminum waiting to be recycled. Yeah. And they're not there right now economically, but it's there. So we probably will see higher copper prices because there is a growing demand. There has been an underinvestment in copper mining, and there's been an underinvestment in copper recycling. And because copper prices were relatively low for many years, there were reduced incentives for fabricators to economize their copper use. That'll come along. You're seeing that already. So the copper market probably is in a long-term bull market. There's probably a lot of hype that makes some people more optimistic than they should be. And then within that, you have the short-term volatility where copper prices can spike to $6. I mean, and let's be honest, a lot of the $6 reflects Trump's 50% tariff. If you go back and you look at copper prices, they got up to 596 last week.
Incredible.
Last Thursday, right? But if you go back all the way to a month ago, June 18th, they were 480. And if you go back to January, the beginning of January, they were $4. So you've seen a 50% increase in copper prices in the last 6 months. Is that sustainable? Probably not. That partly reflects it. Now, if you go through it, okay, when Trump announced his great, big, beautiful tariffs at the beginning of April, the price of copper had gotten to 520 before that. And within 3 days, it was back to 412. So it coughed up 20% of its value. It dusted that off. And then when he came up with his 50% tariff, the price was up to around $5, and now it's $6. So he has added substantially to the price. And those tariffs, the problem with those tariffs are he is so quixotic. And it's also not quite clear exactly how all of these tariffs are being imposed. So there's a speculative heat built into $5.85 copper right now that one has to be worried about. I wouldn't buy copper today as a long-term investor at 585. I would be interested in buying it if it got down to $5 or lower.
So what is your sense then on the stocks, say, like in London and Shanghai? Like London, we're seeing some stories about because of the tariffs and everything, and maybe this is part of the reason for this rise in price, that a lot of this metal was going to the US and that the LME, where their aluminum and copper stocks seem to be getting quite low from the reporting.
Right.
Do you have any sense of what's in London and Shanghai?
I haven't really looked at copper. Again, that's Carlos Sanchez's purview at CPM Group. I haven't really looked at it, but there are inventories. And then the question is always, are there inventories that are not reported? Because like in London and Shanghai, those are warehouse inventories. But fabricators, seeing what was happening, would buy copper and aluminum and move it to their factories. And that copper and aluminum doesn't necessarily get reported in all of the inventories that you see. So if you're looking at London and Shanghai market inventories, you won't see fabricator inventories. But part of what you see in the decline in non-fabricated inventories may be advanced buying for inventories by fabricators. That's what we think you're seeing with platinum and to a lesser extent with palladium in China. You saw an increase in platinum imports in April and May into China, but a lot of that seems to be showing up in the Shanghai market as market inventories. So it was people saying, okay, things are going to get worse, price is low, let's buy some stuff and move it into China before things get worse. So it's not necessarily fabrication demand. And then you can say, okay, did these guys just buy the future price? Will the price be lower in the future because they were buying metal they'll use in the future today instead of in the future? And then the other thing is, if you take a step back and say, okay, yeah, platinum imports were up April and May, but in the first 6 months and even in April and May, they were off from a year ago. So it's a much more complex. I mean, I know people like simple stories, but the reality of how the global economy uses raw materials is much more complex than storytellers would like us to believe.
Indeed. And I fear my next question is going to be asking for a simple answer here. But
sorry.
So to be clear then, if I understand you correctly, in a sense, Shanghai is the reason, switching over to platinum and palladium, like a lot of the demand is coming out of China. And do we know what it's being used for? Or did you basically just explain that we don't know and it's kind of complex, or do we know? Like, we don't
Yeah.
know, as you say, like this is just the
Yeah.
future price. Like, is this stockpiling? What's going on here?
Well, first off, there has been some increase in platinum jewelry. There has been some increase in platinum use in electronics. There's been some increase in platinum use in auto catalysts within China. The bulk of what we've seen seems to have gone into inventories, market inventories, or fabricator inventories right now. And that inventory building has been in China, but it's also been in North America and in Europe. And I think it reflects the uncertainties of global trade, as well as uncertainties about South African production. So I think that has been the major thing that you've been seeing is an increase in inventories. There are people who will tell you that platinum jewelry demand in China has risen sharply last year and in the first half of this year. There are other companies, including the company that used to be the largest importer or exporter to China of platinum. They think that platinum jewelry use was down last year. So there's a lot of questions. And, I've sold PGMs into China for decades. And it's very funny because a whole range of PGMs, never sold osmium. When you ask where this metal is being used, they always say jewelry. And there's a reason for that. If you say, oh, we've got a new electronic use, or we're using iridium in crucibles to make LED lights, and we're really pushing the LED lighting industry in China, then you've got this whole explanation that you have to make. But if you say, oh, it's going into jewelry, you say, oh,
Right.
okay. Yeah.
No
Yeah.
explanation required.
Yeah.
I mean,
So, I've sold enormous amounts of metals into China that I know did not go into jewelry, but was always told it's going into jewelry.
I mean, the question lurking at the back of my mind as you say this is this going to military?
Some of it's going into military, but a lot of it's going into electronics and chemical catalysts and the equipment that makes electronics. So you use iridium, platinum iridium crucibles and other things to make crystals for LED lighting and infrared lighting and laser receptors. You use platinum rhodium alloys for making fiberglass and fiber optics and a variety of other things. Part of that is military, but a larger portion of it is civilian.
Okay, excellent. And just kind of on this point before we tackle silver finally, but I assume obviously you saw the story with MP Materials and the Pentagon making this big investment and putting a price floor on some of the rare earths. My
Yeah.
sense is, the attention is on the rare earths right now, but it seems to me like if all of a sudden copper becomes an issue and all these other things, I mean, is it crazy to think that that could happen to other metals as well?
No, it's not crazy. It could happen. I think the rare earths, this is money that the government will never get a return on. I think the rare earth investments are a mistake relative to the reality of the rare earth markets, which is grossly obscured by all the hype and political rhetoric that's going on right now. But the reality is, if you go back, the United States used to have it used to mobilize its military for wars. And it was always going to war, so it was always mobilizing, and then it would demobilize. And after the Spanish American War, it demobilized. And there were some very smart people like Bernard Farouk who said to the government, this doesn't work. And we can see where the world is. You have the Boer War going, you've got the Spanish American War that just ended. We should have a civilian preparedness board that prepares the country for the next war. And then that became the War Preparedness Board. And part of that was the National Defense Stockpile, right? And they kind of started to build that up before World War One. And then after World War One, they kind of demobilized it. But then they quickly realized that wasn't wise. So they turned around, and that was really the start of the military industrial complex to some extent. It existed before that, but that's when it really became good, and it ran through the 20s and 30s, and they had a strategic stockpile. going into World War II. And then after World War II, you had a lot of people in the military and in the industrial complex that supplies the military who said, we're in the Cold War. We simply cannot afford to demobilize. And that was the big change with everything. So one of the first things they did is they said, railroads are more vulnerable than highways. So the military wants a highway network across the country, at the expense of railroads. And it'll help civilian society too. So that was the death of the U.S. railroad system and the birth of the interstate highway system. And you just saw things go from there. And that's going to continue. Now, in the 70s, 80s, 90s, that kind of deteriorated some. And, people said, we don't need palladium, we don't need platinum, we don't need silver, we don't need this and that and the other thing. But given the state of the world with a breakdown in globalization, a breakdown in international cooperation, an increase in militaristic attitudes toward other countries and militaristic solutions to international problems. In the 1970s, China, the United States, and everybody else agreed at some point Taiwan will reunify with the People's Republic of China in a peaceful political settlement. And then in the last 25 years, U.S. government and then the Chinese government said, no, that's not going to happen. And now we have this risk of a military solution to the Taiwanese reunification system. And when you go from saying, okay, for 30 years, we're going to settle this peacefully, to saying, well, maybe we won't, you start building up armaments, you start building up copper inventories, you start building up everything else. And that's where we are as a world. So it factors into everything. And that's why you want to have things, or you want to invest in things, or the companies that have the capacity to make those things.
Indeed. And just a quick follow-up on that then. Do you think then, it seems obvious that there should be stockpiling going on, but maybe you have a different view. I mean, the EU just recently put out a directive basically saying that they needed to stockpile metals. Is the US doing it? Should they do it? It seems like a good idea, but what do you think?
Well, the US still has stockpiles of some metals and some critical metals. And there has been an effort in the United States, as there is in Europe. When I started in this business in the 1970s, countries were destocking. And as the 80s and 90s led to, the dissolution of the Soviet Union, the rise of a managed capitalist economy in China, the reduction of international tensions, and the rise of globalization, you started to see countries. The topic was, we can dispose of stuff. And, CPM Group helped the U.S. government dispose of its silver and dispose of its platinum that it had in its strategic stockpile. About 15 years or so ago, maybe 20 years ago now, you started to see people say, well, maybe that was a mistake and we should rebuild our inventories now. You saw that in the United States, you saw it in Europe, you've seen it in other countries. How much of that's actually going on is not clear. China clearly has been building strategic reserves of a number of materials. Europe has come to the realization that it needs to do that. The United States is talking about it. We're making some tentative moves like into rare earths, which I think is a mistake, into uranium mining, which I also think is a mistake. But they probably will be wanting to get into other things too. That's, sort of like the state corporatism that is the definition of fascism. You have the state investing in corporations because it's the corporations that matter, not the people.
And so what should they do then? Because it seems like the point taken, but in practical terms, I mean, if you're not going to support the business of the rare earths, I mean, what other choice do they have?
They being the government?
Yes, the government.
Yeah.
If they want to have their own
look,
supply.
if you look at like what we did with the silver inventories originally belonged to the Treasury. They sold much of it during the period where they were getting out of the silver coin business. They took the last 137 million ounces and transferred it to the Department of Defense, which didn't want it. and said, we really don't want this stuff. We really don't need it. We don't think that silver's a strategic stockpile. But the law said that the Defense Department couldn't sell it if it was likely to depress the free market or the private market price of silver. So it sat there. So we came up with the suggestion that the U.S. Treasury start the Silver Eagle and use those inventories. And then once the inventories in the National Defense Stockpile were done, they would buy the equivalent of U.S. mined silver. And that's what's happened. When we did this, I helped write the speech that Senator Jim McClure from Idaho gave in the National Register, Federal Register, where he said, what we're going to do is we're going to take a national defense stockpile that the U.S. Defense Department owns, and we're going to transfer it to coins in the ownership of American citizens. And if we ever need silver for a national defense stockpile, that silver is available from our citizens. So we've transferred the ownership from the U.S. government to individuals. And that's been a tremendous success. Not only did we get 137 million ounces of strategic stockpile silver sold, you've had several hundred million ounces more since the year 2001 that have been bought by American citizens in Silver Eagles. Now, the question is, given the deterioration of civility in the United States society, in an emergency, would American citizens actually cough up that silver? And I think it depends on a lot of things that we just can't determine right now. Yeah. I mean, during World War II, we had all sorts of recycling drives for raw materials, not just tin and aluminum, but all kinds of metal scrap and other things. So it's hard to say. So the government can be doing a lot of things, but, I have no problem with the government facilitating private investment in entities, but I don't see the reason. I worked for 38 years, well, it's more than that now, on Wall Street, and there's a term, other people's money. Yeah. The U.S. government, they say, well, we're going to spend this money. You say, no, you don't have that money to spend. You don't have money. Anything that you're going to do, you're going to have to borrow money. But if you create a tax system and a social system that allows for the efficient use of private capital, then that's a better thing. Use other people's money and create a system that encourages that. Right now, you don't have a system. The tax system discourages private investment in those kinds of companies. And there are political lobbyists that work very hard to make sure that tax system doesn't get changed. That needs to be changed. Once you do that, you're creating an environment where other people, all that money I was talking about earlier, that's sloshing around looking for investments, that money will be invested if you create a tax environment that is suitable for investing. But we don't have that here.
Got it. And you mean investing in like miners, for example?
Yeah, exactly. Okay. Not just miners, but processors. I mean, if you look at one of the biggest mistakes that governments have made in the last several years, oh my God, all of our solar panels are coming from China. We need to develop a solar panel industry. And you have a solar panel industry that globally probably is operating around 50% of capacity because there's been so much capacity made to build solar panels in my country, the United States, and other countries that will remain nameless. Everybody has been building solar panels. They're like a stadium for a city or an arena or a convention center. Every mayor wants to have a convention center. Every country wants to have a steel mill, right? And a solar panel factory. And you have all these solar panel factories for national security purposes. And most of the components, 90+% of some of the components in those solar panels, you're buying from Chinese companies. Right. So we had a government a couple of years ago said, talk to us. We think we should build a solar panel industry in our country. And we said, no, you should be building a component company to supply all those solar panel industries around the world that are under capacity utilization. Yeah, it's the same sort of thing.
Right. And just finally on this point, and then I want to ask you about silver to wrap up here. So is the implication here that ultimately metals processing should be the focus. Like, isn't that really the start of the components?
It starts with mining, and people focus on the mining. But again, it's processing, smelting. The US, I don't know if we have, I guess we have a couple smelters left. In the 1970s, we had more than a dozen copper mining companies in the United States. I think we have one now. Yeah, maybe two. And, smelters, refiners, fabricators, and companies that develop new uses for these things and the capacity to make them. There's this whole chain. And, an ounce of silver or a pound of copper might go through 10 different companies in its process from being mined to being used in an end product. And all of those companies need a tax system that supports their development. And most of those companies are either private or very small, and they don't have access to public equity, and they have a tax system that penalizes them for being successful.
So finally, just on silver here.
Yes.
It's a much discussed market. Many people love to opine on it. The internet loves silver. You just put out a video on it. What is your sense of the silver market right now? Kind of looks like we're going to hit all-time highs soon here, but what is your take on what is being discussed and what is happening?
Well, the silver market's rising. Our expectation has been and continues to be that it will continue to rise. If you look at a quarterly average basis, you may be at record prices already. I'll have to look at it to see. So we think you're headed to record prices. And again, it goes back to what I was saying earlier. Yeah, we have projections for silver going out 10 years on an annual average basis. And we have record silver prices over the next 2-3 years on an annual average basis. But that's different from the spikes, right?
Right.
And playing with the spikes is like trying to catch a falling knife. And I've done that. And I've done it in the silver market, but it's very difficult. And again, you want to think like a long-term investor. Adam Smith and Warren Buffett have basically said the same thing. Yeah, you want to own some gold and silver, but what you really want to own is the capacity to make gold and silver, right? So you want to think like a longer term investor, and you want to say, okay, the price might spike to $50 today. It might spike to $70 tomorrow. It's hard to say because you've got a combination of a tight real market, and then you have all of this speculative froth, and you have let's be honest, most of what you hear is utter nonsense. Silver use in military, running out of. I had somebody tell me last week that COMEX was down to 150 million ounces of silver. It's like, no, it has a record 500 million ounces. There's stacks of silver. There's more silver in refined bullion reserves, mostly held by investors, than ever before. There's plenty of silver out there. So there's a lot of speculative froth, and the price could spike to anything. We wouldn't be surprised to see the price spike toward $50 over the next 2 or 3 years, but it probably won't be sustained there. It'll come back off. And we think that you're into a period of the next 2 or 3 years where you'll see higher record prices on an annual, quarterly, and intraday basis. And then the price comes down, but it doesn't come back down to, $15 or anything like that.
Very interesting. So it sounds like you're making the argument for owning the miners here when you discuss about Warren Buffett and Adam Smith and owning, the production of
Right.
these things.
When Berkshire Hathaway got interested in silver in the 1990s, it was going to buy silver mining companies. It determined that there was not enough equity in the silver market, publicly traded silver equity market, for it to hit its threshold investment target. And it said, okay, if there's not that much equity, maybe we should buy the physical metal. They did, and they made a lot of money. So Warren will say several things, and people will misunderstand him. He did buy some gold mining shares recently, and then when they went up, he sold them. Yeah. So he's not averse to owning the means of production. And that's what Adam Smith was talking about, and that's what he was talking about. Yeah. if you can own the means of production. Yeah. So that's really kind of the key focus there. But the problem is there's a tremendous amount of chaff in that industry, and there always has been. So it's very difficult to say this is a legitimate, good, well-run mining company, and this isn't. And that's a very difficult, I used the term decades ago. These are very lucrative but treacherous waters in which to swim.
A perfect note to end on. Jeffrey Christian, managing partner at CPM Group. Thank you for joining us and sharing your fascinating perspective and all of the historical anecdotes here on this week's Northern Miner podcast.
Thank you once again to Gold Newsletter and the New Orleans Investment Conference for sponsoring this week's episode of the Northern Miner Podcast. Thank you also again to Jeffrey Christian for a fascinating interview. And thank you, dear listener, for continuing to support this program. If you want to help out the podcast, please leave us a review in the Apple Podcast directory, share it with your friends, and until next week, take care.